Welcome back. We're doing a stock analysis on FedEx. Their stock has had a pretty big fall recently, but with our valuation, we're going to see if the price has dropped into a buy zone and if we can make some money in the holiday season on them. So let's get started. So I have a 6-month trend here, and you can see it's been a little over minus 20%. So we're going to see, is there anything in the financial statements that justifies that, and could it be due for a run back up? Just to highlight here too, if you look, we're closer to the 1-year low than we are to the 1-year high. And whenever you're buying a stock or thinking about buying a stock, I always prefer to be closer to the low than the high. I mean, who wouldn't, right? Okay, well, let's get started with the income statement. Total revenue is first. It's growing. That's a great sign. We don't use this for valuation. Let's not waste any more time. Let's go straight to our margins. So first, I want to show you operating margin. And you can see, let me change this to percentage. So you can see it was hovering around 20% and then dropped pretty bad to below 10, 5, 6, 7, 8%. So whenever you see a step change like this in margin, you need to ask yourself, was this a change to the overall margin, or is this just a change to operating margin because they might have classified an expense in a different way? So always go look at the net margin. So that's what we're going to look at. Yeah, and you can see here, no change to the net margin. So it must have just been a different classification of one or a few expenses, just a different way that they did accounting. No big deal. What is concerning though is that this net margin is pretty low. I mean, I kind of expected it. Shipping is a super competitive industry and the price is kind of set, but it's just really tough to compete whenever you're only making 5% on your total sales. Oh well, like I said, that's the industry. Okay, let's look at pre-tax income. That's going to be our first valuation metric. All right, gotta go back to dollars. Okay, so pre-tax income, like to see it growing, and look at this recent growth. That's awesome. Really like to see that. Why would the stock have fallen in the last couple of months? That doesn't make any sense unless people were expecting it to continue on this trajectory, which would be kind of crazy and optimistic. All right, well, what are we going to use for our valuation metric? I'm going to take the average of these last these last five right here. So if I take the average of these last 5, I get $1.6 billion a quarter. So 1.6 times 4, I got to get that to years, right? $6.4 billion. So next is a growth rate. So what do we do for the growth rate? We look at what they're making now, which is the number we just got. And then we say, what were they making about 5 years ago? So if you go back 5 years ago, they were making about, let's say, 1 million a quarter. And we just said they're making 1.6. So the formula for that is 1.6 divided by 1 raised to the 1/5, and that gives us our annualized growth rate, and you get 9.86%. So I'm going to round up and say 10%. So let's go to earnings per share. Remember, we always use diluted earnings per share. All right, let me bring these decimal points back in. Okay, so same pattern as the pre-tax. One thing I want to point out too, though, is that I really don't like seeing these random pretty significant negative quarters. It looks like they happen pretty regularly and that we haven't had one in a while, so I'm worried that we could be due for one. If you know a lot about the company, you might say, no, you're crazy, then this was due to something else and that's not going to happen again. I'm just saying history sometimes has a way of repeating itself, so that scares me a little bit. But I'm not worried about that for this video. I'm going to take the trailing 12 months, so the last 4 quarters, so this one, this one, this one, and this one, and get a yearly earnings per share number. And we are going to get $18.82 per share. So that's going to be what I put over here in the outline, $18.82. All right, let's go to the balance sheet. The balance sheet's going to be quick because I got a lot I want to talk about in the cash flow statement. So we're just going to do the basics for the balance sheet. So let me start by saying I love this pattern. And I got a little bit of a spoiler. I know they're paying dividends. So if a company's paying dividends and growing this tangible book value per share, that is awesome. That means that they're paying back money to the shareholders and they're increasing the net worth of their business. So really like seeing that. Okay, let's use this and get a return on tangible equity. I didn't define this, but tangible book value per share is all the assets minus all the liabilities minus all the intangible assets, and then we divide by the number of shares. All right, so return on tangible equity is our earnings per share, so $18.82 divided by the most recent tangible book value per share. So it is $66. So $18.82 divided by 66, 28.5%, 29% return on equity. Awesome. That's outstanding. But I always like to look at it in relationship to your price per book. So let's do that real fast. Price per book is just the share price, so 240 divided by the most recent tangible book value per share, so 66. And we get 3.6 is our tangible price per book. That's great. You can buy something for 3.6 times book value that is earning 30% on equity. It's a great sign to me. I'll really, really give that a big check mark. Okay, let's go to the cash flow statement. So free cash flows first. All right, I'm not gonna lie. I'm not very happy with this free cash flow. You're hovering really low and you're even bouncing around zero multiple quarters. Usually you will see some free cash flow numbers pop negative and positive, but the average usually runs out. This average is sometimes running around zero, so really don't like seeing that. I know obviously recently they've been doing good and that's gonna be what I use for the valuation, but this past history kind of worries me. All right, well, let's get that number. So I'm gonna take an average of these last, 6 quarters. So if I do that, I get $900 million per quarter. So 900 million was our average. So multiply that by 4 to get a yearly number. And we get 3.6 billion. It's 3,600 million. So 3.6 billion. All right. Now let's try to figure out why this free cash flow is so much lower than our pre-tax income. Usually your pre-tax income is going to be a little higher, but to have it, close to double, that's a red flag. Let's look at depreciation. So depreciation is how much on your income statement you're charging for your assets losing value. So let's see, depreciation. All right. So climbing, and it will climb as your assets climb. It looks like, let's say $1 billion per quarter is what they're depreciating right now on their income statement. Okay, always compare that to capital expenditures, because depreciation is how much your assets are losing value on paper, and capital expenditures is how much you're having to reinvest into those assets to keep them up, plus new assets that you're buying to help promote growth. So it's usually a little higher, but you don't like to see it a lot higher. So let's look at capital expenditures. All right, so 1.6 billion, 60% higher. Because remember, we were 1 billion for our depreciation. That's a little worrisome, but I'm not surprised. I mean, think about how many assets FedEx owns and how many of them are depreciating fast. I mean, they're all vehicles, they're airplanes and stuff, right? Anything that ships goods. So not surprised to see that, but it's worse than I thought it was going to be. Now, you can say this capital expenditure is okay to be higher because they have a good growth rate, and that might be okay. I just don't like seeing low free cash flow. That's just me. Let's look at dividends and repurchases. That's a good way to tell what management's thinking about its prospects and its stock. So dividends to me is a great way to tell what the management thinks about the future of the business and their earning power, and if they're going to continue to be able to pay dividends. And look at this. They just recently increased the dividends, so I really like to see that. They held it flat for, 8 or 9 quarters, and now we're just increased it pretty significantly. They went from, 173 to 200, so 15% increase? Yeah, roughly. That's great. That means that management thinks that the future earning power is going to be able to support that. Okay, so let's look at share repurchases. So dividends are good because they tell you what management thinks about its future earning power, but repurchases are better, I think, because they tell you what they think about their future earning power and the stock. So companies that are repurchasing shares are kind of betting on the future of their company. That to me is worth a lot. And look at this. They went, 10 quarters barely repurchasing any shares, and then all of a sudden they're spending $500 million repurchasing shares. That's awesome. And you know what? That's even better considering that they're making 29% return on equity. So theoretically, they could put that money back into their balance sheet, get more assets, make another 30% on it. So in a way, they're saying the stock could have at least 29% upside. That's kind of from a theoretical standpoint. But I mean, look at this, $240 a share times 1.29. Yeah, $310. Wow. Keep that number in mind. I want to see if it comes in close to the valuation. Awesome. Let's go to valuation. First one, rule of thumb method, pre-tax income times 10 divided by the number of shares. So our pre-tax income was 6.4 billion times 10 divided by the number of shares. All right, $240. Wow, okay, that was dead on. All right. Next one is going to be earnings per share growth formula from security analysis. So 1882 times 8.5 plus 2 times growth. This one's going to be high, I know it. Yeah. This one's going to be high because of that 10% growth. The other ones are usually a little harsh, so I think this one does a good balancing act towards the other two. And then our discounted cash flow from our free cash flow number. So 3.6 billion is our free cash flow. And then our perpetual growth rate is, we got to choose something lower than the growth rate that we used. I'm going to do 7%. And our discount rate, my discount rate's always 15%. All right, and we get a net present value of $52 billion for the market cap. So 52 billion divided by the number of shares, 0.266. Get $195 for our share price target. Average price target 324. Remember I said that their number was probably higher than 310, so that kind of makes me feel a little better about it. What doesn't make me feel too great though is the cash flow number. I really like seeing my free cash flow higher. I understand why it's not. I kind of talked about that already, but it does make me a little cautious about investing. I think there's definitely potential here. I think management has kind of tipped their hand that they think that there's potential. I mean, shoot, they're spending $500 million out of nowhere on their stock repurchases, so there could be a lot going for them. Before I go, I want to talk about the quote up top real fast, just because one thing we do here is look at a lot of financial information, and I think that's really important, because while I think reading annual reports is a must before you buy every stock, you got to realize that annual reports are going to always try to paint a very optimistic picture, so you have to go into it with a certain bit of cynicism, and in my opinion, a lot of times it's better, especially for first impressions, to look at data almost blindly, just the raw data, and go from there. The quote's actually from the book Common Stocks and Uncommon Profits, which is a great book to read. Warren Buffett says his investment philosophy is 85% Graham and 15% Fisher. I think that's it. And I think he gives a really unique perspective. And if you haven't read any of his material or kind of got to know his teachings, it's definitely worth doing. But anyway, I hope you enjoyed it. I hope you learned something. Please like and subscribe. I will see you next time.